Hi, Steve Van Metre here, and welcome to your weekly economic update, where we take about 30 minutes every Friday and try to make sense of markets that really don't make any sense. And how can they when the coronavirus is kind of running around China and U.S. investors want to buy stocks? Do they not get it? I'm relatively sure they don't, but it doesn't make any sense unless you understand American investing psychology, which says American investors like to buy anything that's high and rising. Best way to make money in any form of investing, where it's stock market, real estate, bond market, commodities, is to buy low and sell high, not buy high and hope it goes higher. Yes, it can, but eventually those highs reverse. So the topic of today's video is, what did the smart money know? And for those of you who aren't aware, I generally write every week a letter, and it goes out to my clients, but it's posted on Facebook, not YouTube, LinkedIn, and on my website at stevenvanmetre.com. So you can go there and check it out. But the smart money knows that when the Federal Reserve begins to ease monetary policy during a tightening cycle, that makes about no sense. So there are lags in monetary policy that run about 2 years. So when the Fed makes a change, it takes 18 months to 2 years for it to affect the real economy. So the tightening cycle has not passed its way through the economy yet. In fact, it won't, I believe, until sometime in 2021. I don't have my notes up in front of me on that. And so when the Fed starts to ease in the midst of the lags of a tightening cycle, it leads to lower long-term interest rates. And the smart money knows that. And that's why you go back and look at, say, late 2016, 2017, the smart money was buying bonds when everybody was selling them. Retail investors own virtually none at this point. They might own high yield bonds, but they don't own Treasury bonds. And then what happened from there, we saw the quantitative computer models come in because momentum on bonds started to rise. I think that's the right way for you to see. Started to rise, and those momentum models said buy bonds. And so it just kind of helped drive bond prices higher. And the smart money knew they would do that. And they also knew that if they could get momentum to flip, those same computer models would sell. And back in October of 2019, momentum flipped, and the smart money took that as an opportunity to buy up more and more bonds. And if we start to overlay the coronavirus and what we have learned about it so far, you might find it, it's just a risk-off event, and the bond market's, it's going to be wrong. No, the markets make the news. The news just tries to fit the narrative into what's going on. And in this case, what do we see? The bond market's starting to rally, and it would have rallied anyways. It's got some news behind it that sounds really good, the coronavirus. But now we're seeing bonds starting to rally. They've got one more point to break through, and then we're shooting at the next great bond bull market, which are very quick and extremely profitable, which is pretty cool. And the smart money knows that. They know that they can squeeze all these people who are in equities out, and they know these quantitative models, these risk parity models, the vol control models, they know that most investors have no exposure to bonds, at least Treasury bonds. They know the hedge fund managers and other speculators are short. They understand how short the entire investment community is on bonds. And guess what? They have gone out of their way over a 3-year period to buy as many bonds as they want. Now, a professional investor will tell you, or maybe a very seasoned investor, before you buy something, you should know who you're going to sell it to. Now, most people have no clue, but the smart money, they already know. They're going to sell it to the people who need it, because when bonds break out into a bull market, it pulls liquidity from the market, which is already very short liquidity. So think about this, right? You're short the bond market. You bet against it. You're not short it that you don't own it. You're outright short. There's two ways to think of people being short something. I could say I'm short coffee right now. I don't have any coffee here in my office at the moment. So I am short coffee. I'm not betting against it. I've not gone and bet against a cup of coffee sitting in my office. I just don't have any. Now, if I needed some, I'd have to go get some because I don't have any at the moment. That is being short. So there's two ways you can be short. You can just not have something that you want, but don't know you want it, or you can be betting against it. So in the case of the bond market, when do investors want bonds? When stocks start to fall. So here's how this happens. Bonds break into a bull market. You see a speculator who has bet against it. Now they need to cover their short position. How do you cover a short position? You either close it by effectively buying a long contract, or depending on how you're short, you have to go out and buy a bond to hedge your risk. So what do you need to do that? Well, you need cash, dollars. And guess what? We're in the midst of the largest dollar liquidity shortage in the history of the world. We've never been this short of dollars. We also know that money managers have a very small allocation to cash at this time, and so there aren't a lot of dollars. So when these people, the speculators, have to go out and get dollars to buy bonds or to close their speculative position, they're not going to have enough. So what do they need to do then? Well, maybe they'll go out and sell stocks, okay? And what's going to happen there? That creates a demand for cash, bringing the price of the dollar up. But there's a second problem. When you're forced to sell stocks and you're also short volatility, which they are, volatility starts to rise. Well, guess what? Now you need to cover your volatility shorts. It's like those cartoons where the water's coming in the hole of the boat and they're trying to plug it in all different ways. And every time they plug one, another springs loose. And this is what happens in late stages of bull markets when people have taken excessive risk and are betting on something they don't understand. See, owning stocks right now I know people think, oh, it's a bet on President Trump. No. It's a bet on the U.S. economy. No. What it is, it's a bet that the Federal Reserve can starve off the next recession. That's what you're betting on. You can change all the players. Swap the president out. Swap Congress out. Swap everything out. You're betting on the Fed. And the Fed has a 100% track record of failure. And you say, well, hey, that's pretty good because this will be the time. If you own bonds, you're betting that the Fed will be wrong, just like every central bank in the history of central banking has ever been. No central bank has ever mixed that right cocktail up to create perpetual economic growth. So it's not about who's president. It's not about the economy. It's all about monetary policy. So if you own stocks, you're betting on the Fed. If you own bonds, you're betting against them. Those who are betting against the Fed, so far in history, have a 100% probability of being right. Yes, maybe this may be the first time in history, but if it was, think about this. Why would the smart money, who has access to more information than you and I will ever have, why weren't they chasing stock prices up? Instead, they were out buying every last Treasury bond they could get their hands on. Why would they do that? Because they know what you know. You bet against the Fed because they're always wrong. You bet against central bankers, they're always wrong. So today, markets were down. The NonFarm Payroll report was a beat, big surprise. The most faked data of the government, because look, I'm not picking. Some of you think, oh, you're picking on President Trump. No, go look at the history of the Bureau of Labor Statistics. It doesn't matter who's president. They overestimate numbers all the time. And if you don't believe me, they just revised the 2018 data down by 500,000 jobs. That's a lot. It's a lot of jobs. That's like $40,000 jobs a month to be wrong by. And they do it every time. So the BLS deliberately overestimates because when people feel good, you got to think, in a debt-based economy, what do we need? An expansion of debt. And if you feel good, right? If you feel like, man, the economy's good, my job's good, I'm going to get a raise, things are good. What do? As an American, you go out and spend, but you borrow and spend because I want car today, I'll just pay for it over time. That's what drives our economy. So the BLS knows that, And so they overestimate. And then, 2 years ago, we were wrong by 500,000 jobs. Yeah, and don't worry about it. Well, the market didn't love that. But what the market isn't loving right now is that bonds are starting to move back up and are flirting with the breakout level we're going to look at. And the dollar is rallying, which is a big problem because a stronger dollar means tighter financial conditions and is usually something that occurs going into recessions. You see dollar starts to rally going into recessions. And what's going on in China is going to lead to a stronger dollar. The economic impact of the world's largest export effectively shutting down large chunks of their economy are going to have knock-on effects all around the world. We haven't seen them yet, but we will. So let's take a look at the data. We've got the M2 money supply, and this is really interesting because securities and bank credit rose, look like 13 billion, but most of that's coming from mortgage-backed securities. You don't see virtually any change in Treasury, so banks are just holding their Treasuries pretty flat. Here you see, again, mortgage-backed. They bought some non-government-backed Treasuries of some sort, but you'll notice they're buying up a lot of mortgages. Now, why is that? Well, there's two things you have to understand. The Fed, despite easing, is still rolling $20 billion per month off of their balance sheet of mortgage-backed securities, and banks are probably the only ones that really want these things. Got to remember, these are those toxic mortgages that nobody wanted. So the Fed bought them, and the Fed owns 2/3 of all mortgages. So the Fed's trying to get rid of these things, and it's going to take them a long time. But you know how we talk about the refinance data over the last couple of weeks? It just shot straight up. So if 2/3 of all mortgages are owned by the Fed, that suggests that 2/3 of all refinances are going off the Fed's books onto bank balance sheets. So banks are starting to choke down all of these mortgages. And what happens is they buy out mortgage bonds. Does that put upward or downward pressure on interest rates? The answer is it puts downward pressure on interest rates. And let me show you the chart that we've looked at before. And here you see Treasury and agency securities of mortgage-backed securities on a year-over-year basis is back rising up. And you have the inverted 30-year Treasury yield rising, so it's inverted meaning it's falling, suggesting that there is a fairly decent relationship between how the size of a bank's balance sheet of mortgage-backed securities on a year-over-year basis and the direction of Treasury yields. So that implies that Treasury yields are headed lower. Adding to that view is Treasury deposits. The Federal Reserve banks are rising, which is normal after the Treasury goes on a big borrowing spree. It continues to raise cash to eventually spend it later. And generally when they raise cash, as you can see here in blue and here in blue, it leads to lower long-term interest rates. And why is that? Because they're pulling money out of the U.S. economy, sitting it in their bank account, and with less cash in the economy, interest rates need to fall to spur lending demand to replace that cash. And that is also partially why when this cash gets spent out, usually interest rates start to rally ahead of it. Not always, but usually do. You see in this case here, they didn't. It could have been this little rise here was a delay of that. And so it tells us that interest rates are headed lower in every possible way. Let's go back to the PowerPoint. And we'll see here we've got, the M2 money supply growth rate is roughly flat at 7.07% from a year ago. Most of this increase is in savings growth, and a little bit now is coming from institutional money market funds. The 6-month rate of change is rising. The 3-month rate of change is rising. And now I want to go take a look at the lending data, and then we'll go and pick back up on the charts. So let's go back here. We see total loans and leases at all commercial banks rose $6 billion over last week. Not a huge amount, but still rose. But notice commercial industrial lending is virtually flat. Commercial, I'm looking back and forth here. Real estate loans. Now we do know that real estate loans should be rising, rose by $8 billion. We would expect that most of that is in residential because we know there's a lot of refinancing going on. And so this is telling us that those refinances are cash out refis. Now, where is that cash going? Is it possible that it is going to start paying down on some of these consumer loans? Possibly. Are people cashing out to live on? Possibly. We see commercial real estate loans were flat, so nothing exciting going on there. Automobile loans, so you look at demand from the auto industry, flat. I mean, there's virtually no demand in the auto industry really going on, and that makes sense if you've been to a dealership lot lately, and I have, since my son works at a car dealership. I can tell you, business there is really slow. You know, when he calls you up and says, "Hey, you want to go take some cars out for a test drive? I got nothing." You know, "Hey, sure, I got nothing going on. Let's go have some fun." And you go out there, and there's just nobody buying cars. So you see that in the data. So let's go back and take a look at the real estate loan growth is just still under 4%. Now here's the 4% not. You say, well, it looks like it's closer to 6. It's really under 4. And it's been under 4 for a long time. I mean, it just cannot get any growth here despite interest rates being low. And so what does that tell us? That interest rates are still too high, because we need real estate lending growth to be up here minimally around the 6% range. So we need interest rates to drop a lot to get homeowners to cash out, either cash out equity or refinance their payments down to go finance some other stuff. Maybe go buy some cars for my son. I know he'd appreciate that. So real estate lending's flat, just under 4%. But the 6-month rate of change and the 3-month rate of change are both rising a bit. Not stellar numbers, but they're rising, and effectively just validating that this 4% number is fairly real. But no substantial growth there. Commercial industrial lending is roughly flat at 1.26%. So you see it's trying to bounce off here, but don't hold your breath, because the 6-month rate of change is negative and falling, and the 3-month rate of change also negative and falling. And if you think the coronavirus is going to lead to a surge in commercial lending, it's not. So looking at the total loans and leases, all commercial banks representing 1/3 of all debt in the economy. The growth rate is flat at 4% and is extremely weak. This needs to be well up in the, say, 7 to 8% range. So 4 is very weak. The 6-month rate of change is flat, mainly due to the offset between residential lending and commercial lending. And the 3-month rate of change is flat at 0.55%. This is very low, but these numbers again are just validating that yes, the 4% rate is correct. So looking at credit card growth rate, we continue to see that starting to roll over. Consumers are pretty tapped out. We're not seeing, we're seeing wage growth, but we're not seeing hours worked really rise a whole lot. So the data is not really conducive of big paychecks coming for American workers. So this is down to 4.45% from a year ago, and my guess is that will likely continue to slide. So let's go and spend, let me get that back where I need it to be. And let's take a look at, we'll spend the rest of our time looking at some charts. And, you know what, is there something else I wanted to look at? We can look at that on Monday. And I'm really going to be really curious on Monday to see if hedge fund managers are still short the bond market. I'm guessing they are, and that would be great news. So this week on Twitter, Raoul Pal, a macro investor, he posted his charts, and he's really quite good at technical analysis. I am mediocre at it, but good enough that I don't draw precise lines. But he drew a rather precise lines under 10-year Treasury yields, and he said, take a look at this. 10-year Treasury yields broke and gapped down, and then have gone up and have touched. So they broke this kind of angular support line, and then went back up and confirmed resistance, to which he said will then make a run back at 1.4%. And if 1.4 is broke, you're now looking at negative 10-year Treasury yields, which I completely agree with, as anyone who's listened to this video or my videos in the last, probably a couple of years. But anyways, that's where the yields are headed, and that's a big return for bond investors. So you can see here you have 1, 2, 3 bottoms at 1.4. There are no quadruple bottoms because they just don't happen. When you knock on the door of support enough times, you break through. So what we can expect in the weeks to come is interest rates to fall. And again, with demand going away due to world's largest exporter, having their economy shutting down, you can expect to see credit demand fall. And along with that, interest rates fall. You break 1.4 and you're going to watch liquidity get yanked right out of the stock market. And we can see the same line that I drew on 30-year yields matching where he had drawn it on 10. And you see that yields came through, gap below, went back up, confirmed right here, which I'll zoom in. This is overhead resistance, held resistance for 2 days, and then boom, gap down today and saw yields falling for the better part of the day. I think they came back up a little bit right before close, and we'll look at bond prices since, again, for those of you who are new, this thing does not show the last 30 minutes of trading on Treasury yields. I don't know why. But what we do know is, I should have looked at 7-year, but every 5 years and under are all below the federal funds rate. So yields are below the federal funds rate. 7 years are very, very close. 10 years are getting close, and 30 years will likely never be inverted under the federal funds rate. But stranger things have happened. And since banks lend at long-term rates but borrow at short-term rates, they're not really making a lot of money on an inverted yield curve. And all the bond market is telling us is the federal funds rate's too high. That's what it's telling us. And when the Fed cuts rate, you're going to watch the bond prices are going to skyrocket and yields are going to tank. I mean, the Fed is kind of keeping this thing intact, but there's a big amount of pressure building behind the bond market, because you can see this massive, as we looked at triple bottom, this is the largest topping pattern, but starting back here in 2012 of 10-year treasuries in history. And when this breaks, when this dam literally breaks at 1.4%, you're going to watch a massive amount of pressure drive yields down, and it's just going to suck the life out of the stock market and watch stock prices head lower, which it does every time. Now let's go look at bond prices. We'll stick with TLT. You'll notice I've drawn that trend line in, and you can see where it gapped over, came back, and retested as support. I'm going to give you a different reason for those of you who are interested in technical analysis or like technical analysis. Let me see if I can click on this and get rid of it. Is why? Okay, so we know it found resistance here. Why does it find support here? Why was this an important place for bond prices to go check in? That's what people should be asking. It's very simple. The people that were sellers here were also sellers here and sellers right in here. And what these sellers wanted to do was see if the people that were sellers here and in here were still interested in selling. And what did we learn? They weren't. So what does that mean? It tells us that bond prices are going to go back up and see where these sellers are to see if there's still selling demand. If there's not, it'll break through here, and then you're off the races. If it finds resistance here again, or anywhere up in here, it will come down and try to fight its way back and forth. My guess is the next time through, we break through. Because again, you knock on the door, we've knocked on it once, twice, and now we're going to knock on it 3 times pretty quick. I believe you're going to see this break right on through. Speaking of technical analysis, and you can see this is just a beautiful charting pattern of that bottom going back. Again, here's what the smart money knew. We don't need to go back. That's too far too. The smart money knew this was a bottom to buy. They knew the quant computer programs would come in here and drive bond prices up. We'll zoom in a little bit. And then the momentum shifted. The smart money bought all along in here. And then the coronavirus starts to get out right here early December is when we start hearing about it. And now you look at this and say, well, that's all based on the coronavirus. No, it's not. It's just based on the fact that the market is squeezing out these shorts because the biggest players with the deepest pockets are buying bonds. It will just be very coincidental when this breaks out. It'll be a risk-off event. And don't worry, the coronavirus will play a big part in that. Let's take a look at ag commodities, which are forming a massive head and shoulders bottom. Here you have your left shoulder, head, right shoulder, and we're starting to see prices rise here. And this could be in even a bigger picture of a bottoming structure that could go and bounce around between the 16 and 17 range and then go from there. But if you just take a measured move between here and flip it up, it tells us that this thing is headed up into the $20 to $21 range. If it's part of a larger structure, it could go even higher. Now, you say, well, I don't think there's demand in ags. Well, maybe you should go and look at, in Africa, there are 360 billion locusts starting to eat up all of their crops. Not to mention we had the worst flooding in history in our Mississippi Valley, and then China had flooding. You have swine flu roaming around Asia. You have chicken flu running around. Yeah, it's not good. There are people that know that ags are going to come into play, and they've been buying it. Look how long they've effectively been buying ags ever since August of 2018. They've been buying this whole structure up. So again, it won't surprise me. Remember, at one point I said this could be a head and shoulders bottom. It's looking like it now. I'm going to wonder if it gets up in here to the $17 price range, bounce around, and then take off from there. But this is a massive, massive bottom. Let's take a look at crude oil, which is bouncing around $50 a barrel. We looked at this earlier this week about how this is a massive support level at 50, and if broken, suggests that crude oil is headed down into the mid to low 40s, most likely 42. And the reason is because, well, that's where it's ended up before. And you can only imagine what it's going to do to oil company stocks that are always also falling off the edge of a cliff. We can take a look at ExxonMobil, which is trying to find support back where it was in 2010. And not having a whole lot of luck, not a ton of volume here, so it's elevated volume, but not a massive amounts. This is not bottomed yet. And you see Chevron stock, which is broken out here, trying to rally back, but if it can't get back up into this triangle pattern, which I doubt it will, it's telling us that Chevron stock too is headed lower. And why do I pick on those two companies? Because they are the largest two positions in XLE, and we can look at XLE and see it's trying to find support back where it was in 2016, and it's trying to find support from back in 2010. And it's very normal that when you break a major trend, it tries to rally back up like you see here in 2010 and 2016. And if it fails, that's where you get the much larger sell-off. And if you don't think the coronavirus is going to lead to lower oil demand, it's going to lead to substantially lower oil demand. Let's see what else I want to take a look at. I'm as bullish I am on gold mining stocks. I don't think this is the right time. I think this move here gets reversed. The market thought this was kind of a big lever, so you get a rally, a sell down, and then a flip higher. Well, it ran into resistance. It's running into resistance at making lower highs. To me, it doesn't tell you that we're ripping these shorts out. I believe that you're going to see, just like we have back in 2008, a sell-off in gold. Now, why would I think that? Because the dollar is rallying due to the dollar shortage. Look at this. Why did the dollar rally? People now don't ask the right questions. Why did the dollar rally? Because we had dollar shortage. Look, going back to 2015, the market was sniffing out what the Fed was doing. So now you have what appears to be a massive topping pattern in the dollar. But do you ask yourself, how do dollars get created? Let's do that. How do dollars get created? If you just said the Federal Reserve, Fed doesn't create dollars. It appears that they do, but they don't. How do you create dollars in a debt-based economy? If you said when people go and borrow money, ding, right. So when we look at lending and you see this just super weak lending growth, you're not seeing dollars being created. When you see global trade slowing down because of the coronavirus, you're not seeing dollars created. So this is telling us that dollars going higher, and that means most likely gold is going lower. And gee, when did we last see that? Going into the last recession. I don't know how far back this goes, but let's see, 2000. Yeah, you see, you get a dollar. It doesn't go back any further, but dollar rallied into that. And now you can see this massive topping structure, which I think will be extremely bullish for gold and gold mining stocks. I just don't see it being bullish today because look at gold. It is breaking through overhead resistance at 90, roughly right around here at 98, and it's telling us its next move is to go revisit 100. That is going to be a major hit against American companies. And if it keeps going and kind of revisits these highs up here, you've got nothing but the recipe for, look at this, 2016, you've got a recipe for another major correction in the stock market. And unless China's economy can come back online, if they can get a handle of the coronavirus, the dollar shortage could get really bad. And what will have to happen to alleviate it? Federal funds rate will go to zero. The Fed will have to QE. 10-year Treasury yields go negative. 30-year yields fall below 1%. And then you hope it works. But if the coronavirus persists, the dollar could really rally and just rip this whole market to shreds. I'm Steve Van Metre. Appreciate you taking time to watch. We'll be back Monday to take a look and see if the hedge funds, how they're positioned. And I'm very hopeful that they're still net short, because all they're doing is putting more ammunition behind what will be one of the biggest bond market rallies in history. The content of this video is provided as educational information only. Is not intended to provide investment or other advice. This channel is not to be construed as recreational or solicitation by selling security, financial instrument, or to participate in any particular trading strategy. This video was prepared by Steven Van Metre on personal capacity. Opinions expressed in this video that one do not reflect the view of Alice Financial Advising or Steven Van Metre Financial.